Now we will see one example of option. Outcast Corporation invested idle cash by purchasing a call option on Counting Crowns, and they paid for those options $360, and the notional value of the call option is 400 shares, and the option price is $40. That means Outcast can purchase 400 shares for $40 each, and for those options they pay $360. Now the option will expire on January 31st, 2025, and these are the dates. On different dates you see the stock prices and time value of the call options, and they prepare financial statement, third quarter statement on September 30th, and then annual statement on December 31st. So based on the stock price on those days, we will update the options intrinsic value. We'll also adjust the time value of the option. So we need to do the journal entries. On August 15, first journal entry, we will record when the company invested in call options. So we will debit call options. Remember, call options, we show it on our balance sheet. It's an asset, so we will debit call option, and the price they paid is $360, and then we will credit cash because for those options they paid cash, so we'll credit cash $360. Then on September 30th, they found that the market price of the share is now $48 per share. Option price is $40, so we will adjust it. So although we are not exercising or settling, actually not buying or selling shares, still the value of the option is increasing because the market price of the share is now 48, but we have the right to purchase those shares at lower price. So at this point we will record unrealized holding gain. For each share we are having $8 gain, and it's for 400 shares, so we will credit 400 times $8 as unrealized holding gain, and it will be on the income statement. On the other hand, we will also increase the call option value. So we will first increase the call option value or debit call option, and the amount $8 per share and 400 shares, so it will be 3,200, and then we will credit unrealized holding gain or losses. It's a gain, so we are putting it on the credit side. Unrealized holding gain, we can use the same for loss, showing it on the debit side. Remember, this is an income statement item, 3,200. Then here December 31st, we will also adjust it, but before that look at the time value. So originally we recorded these options. This is capturing the time value, and the time value reduced as time passes. The time value for the option also decreases, so now time value reduced to 180. So we will reduce the option value by 180 because of the decrease in the time value, and we will also show this 180 as unrealized holding gain or loss, showing it on the debit side. So we will debit unrealized holding gain or loss. Putting it on the debit side means it's a loss, so we will debit unrealized holding gain or loss. Again, the same income statement item. It's the difference or option price time value reduced by 180 debit, and we will also credit or reduce the value of the options. So call option also 180. So this is how we adjusted the value of the option, and we showed the impact recording unrealized holding gain or losses. We will do the same thing on December 31st. Again, December 31st, we are not exercising the options, we are not settling the options, but because of the stock price change, we have to calculate how option price changes and whether we have any gain or losses. So December 31st, we will check the stock price. Now we will compare the stock price compared to our previously adjusted price, because our call option already reflected this $48, but now compared to that, stock price went down by $2. So we actually have to here reduce the option value by $2. Remember, when you want to purchase something at a lower price, if the stock price goes up, you will make a gain. Option price will also go up because you have the right to buy the same stock at a lower price. But if a stock price goes down, option price also goes down, and it's a loss. So this $2 per share multiplied by 400 shares, we will debit it as unrealized holding gain or loss. It's a loss, but putting this account on the debit side means we are treating it as a loss. So unrealized holding gain or loss, it's an income statement item. Now we will compare these two prices, $2 per share multiplied by 400 shares, so it's $800, and it is also reducing our call option value. So we will credit call options, and this is also $800. We'll also check what is happening to our time value of the option, and you will see, and also we discussed earlier, as time passes, time value of option also reduces. So now if you compare these two, time value of the option reduced here from 180 to 65, so which is a difference of 115. So we will also reduce the call option value by 115, and we'll debit it as unrealized holding loss, or you can use the entire account title, unrealized holding gain or loss. So the difference between these two, 115, and we will also credit call option 115. Now we will do our other journal entry on the settlement date. Now we will do the journal entry on the settlement date. On January 15th, they settled the call options. On that day, stock price is $47 and time value of the option is $30. So what we need to do, we need to adjust these prices, and we also need to receive the cash that will be based on the option exercise price and today's stock market price, because there is no physical like share purchase, sale, or transfer. Basically the option is settled with the other party based on the price differences. So first, on January 15, let's do this time value reduction record. So we will actually reduce the option value from our previously adjusted value, which was 65, and now time value of the call option is 30, so we have to reduce it by 35, and we use the same account, unrealized holding gain or loss. Showing it on the debit side means it's a loss, so we will debit 35, and then we will reduce our call option value. We will credit call option 35. Then we will do the settlement. Now for the settlement, there are a couple of ways to do. First, you can take this price difference. Price is increasing, so call options intrinsic value is increasing. So we can do this $1 price increment record first, then we can settle it, or we can combine both and do one entry. So now here we will do a little quick T account to see so far what is the option, call option balance. So I'll do a little T account for call options. So here, when we first purchase the call options, you see here on August 15, the option debit amount was $360, and then September 30th, call option value increased, and we also recorded a debit amount of $3,200. Then we credited call option because of the option value went down because of the time value of option decrease. So we're gonna credit here 180 again. December 31st, stock price went down, so we reduced option values by $800. So we will credit $800, and then we will also see the time value of the option reduced, so we also credited 115. Now based on these and the last time value reduction 35, that also reduced the option price, we will calculate what is the call option balance. So the call option balance, you will find 2,430. So what we will do on the settlement date, we will eliminate that. It's a debit balance, so we will credit that. We will record how much cash we received, and comparing this exercise price and the settlement date's market price difference. You remember, for options we actually do not transfer, buy or sell shares, but just check the price difference and settle and record it, and then the difference will show as a gain on the settlement date. So for this last journal entry for the settlement, we will first take this price difference, and from the other party, from each based on this price difference, exercise price and current market price, for each share we will receive $7, and we have total 400 shares. So we will receive cash, which will be debit. Cash will be debit $400, and then we have to eliminate this call option, which was a debit amount. So since it's settled, we need to remove the call option from our balance sheet. So we will credit call options value, what we have, which is 2,430. So we will credit call options, and here we will show the difference as gain on settlement of call options. Again, you could break it into two journal entries, what we have seen on the PowerPoint slides, or you can just combine it. So the difference will be recorded as gain on settlement of call options. Sorry, here we have 400 times 7, so we are receiving cash 2,800, and we are removing call options 2,430. So this difference we actually credit as gain on call option settlement. So we will credit as gain on settlement of call option. It's another credit item. So the difference will be here 370. So this is how we record the call options on the purchase date, and on different dates when we prepare financial statement based on the market price, we adjust the option values, and we use this unrealized holding gain or losses, which is an income statement item, and we also show how we settle the options.